I'm Charlotte McLeod with investingnews.com, and here today with me is Lepard, Managing Director at EMA. Thank you so much for being here.
Thanks for having me on your show, Charlotte. Enjoy it.
Really good to be catching up with you in person this time.
Yes,
nice.
Correct. Yeah.
Yes, and we're here at the New Orleans Investment Conference. So I follow you on Twitter, or I should be calling it X at this point. And you're mentioning that when you're getting ready for your presentation, you revisited the talk that you gave in 2021 at this event. And interestingly, not too much had changed. So definitely the massive debt problem that we've discussed in previous interviews, and you talk about this frequently, has gotten worse. And yet I think the Fed seems pretty pleased on its progress with inflation, pretty positive about the economy. So tell me about the cracks that you are seeing right now.
Yeah, sure. So as you know, of course, they're going to spin it that way because they're a political organization. And the cracks that I am seeing is that while they, and this is the pattern of the Fed, they tend to break things and then they do emergency measures and get things back under control, and then they break again. And so the last thing they broke was they broke the no inflation, conditions that they had pre-COVID, and COVID came along. They grew the money supply 40%, and suddenly we had 9% inflation. It was raging, and they realized they'd overshot on the money printing, and they'd been too loose for too long. They were still doing QE and buying bonds late into the once inflation was already going. They were claiming it was transitory. It wasn't. Then they tightened like crazy, and they sent everything in the other direction. And so that's the regime we're in now, where they have brought inflation down, not to what they hoped to bring it down to. They hope to bring it to 2 or below. They're not there yet. They're in the 3s. And there's some indications that it's maybe starting to turn back up, but whatever. What I see that the bigger problem that I think the Fed has is actually more at the United States federal government fiscal level. And this is what happened just in a nutshell. When COVID came along, federal government spending really went up. I gave a presentation at the show earlier, and that's available on my X feed, that shows a chart which shows that pre-COVID the government was spending about $4 trillion a year. COVID came along and that suddenly went up to 6.5. Really, really rapid expenditure growth, obviously to counter a pandemic and an emergency. But the thing is, when the pandemic was over, you would have thought it might come back down, and it didn't. It stayed high. In fact, it's gone up. This year it was just 6.75 trillion. And so, in an economy where the stock market is at record highs, employment has recovered from the COVID dip, and, inflation has come back down a bit, we are still running very big deficits. Last year's deficit was 1.8 trillion. And with the last 6 months annualized, the deficit's now 2.4 trillion. And so the problem there is that adds to the debt, and so the debt is growing very rapidly. We just crossed 36 trillion. And the problem with that is that with these higher interest rates that they put in place to beat inflation, suddenly the federal government interest expense has gone straight up. And so there's also in my presentation a chart, and most people have seen this chart, that shows U.S. federal government interest expense for the last 15 years, and it kind of trends nicely, slowly up, and then suddenly it just goes vertical. And so we are now spending about $1.2 trillion a year on interest. It's more than we spend on defense. It's almost as much as we spend on Social Security. And so the interest on the debt has really caused the fiscal problem. And so what that then leads to, the follow-on knock-on effect of that, is what I call a fiscal doom loop, or other people call it fiscal dominance. A lot of ways of looking at it, but it's pretty simple. Your interest cost is higher, so it's a bigger number. That bigger number goes into the budget. Your tax revenues haven't gone up that much, therefore your deficit is bigger. How do you take care of the deficit? You sell bonds in order to fund the deficit. Well, the bonds go into the market for interest rates. Same amount of demand for interest rates, more supply of bonds. Oh, how do you solve that? Interest rates go up. Oh, but interest rates go up means the government's interest cost goes up. Deficit gets bigger, and rinse, wash, repeat. So it's I call it a doom loop. It's a vicious circle in the wrong direction, which I believe will ultimately lead to the government having to say, okay, this isn't going to work. We are going to institute yield curve control or QE, or we're going to buy the bonds, because they're having a hard time finding people to buy the bonds. A lot of the bond auctions have been weak, and the government, foreign governments and foreign people aren't buying the bonds the way they used to. Net foreign buying has gone down consistently since 2014. That's 10 years of a downward trend of foreigners buying our bonds. And, we're going to pretty soon find that we're kind of like a third world country. And what this is, put in personal terms, this is like somebody who has too much credit card debt and they are having a hard time making the interest payments, the minimum payments, so they go get another card, and then they draw on that and they use that to make the minimum payments on the other. And then when that gets bigger, they go get another card. And I mean, it's just, you're borrowing to pay off the interest on what you've already borrowed. And it just can't go on forever. I mean, I define that as Stein's law, which is if something can't go on forever, it's going to end. And it appears to me like this is getting to the point where it's kind of getting critical. And I think, you've even had some pretty large, high-profile, establishment people say, we've got a fiscal problem here. And, so then that begs the question of what are they going to do about it? And that's a whole other question. That was a long answer to your first question, so I'll let you ask the second one.
Hell, that was really good, though. I think it really sets the stage. And so I was curious to hear from you. All right, so we've got Trump has been elected, and lots of different promises and ideas flying around at this moment, and including appointing Elon Musk to this efficiency department. Yeah. And so Elon has said he can find $2 trillion in savings. So I wanted to ask, of course, now that I hear these numbers that you are mentioning, that sounds like nothing. But what are your thoughts on it?
Yeah, so this is great. So Elon's on the spectrum. He's a genius. He's done a lot of great things, and I have, in some ways, I have a lot of respect for him. But in terms of his ability to be realistic, and perhaps maybe it's why he's done some of the great things he's done, is because he doesn't even believe there are limits. So he envisions something and then he makes it come true, or tries to make it come true. But I can say from my point of view and from an analyst's point of view, there's just no way you can reduce the federal government deficit, by $2 trillion. You just can't. I mean, unless you want to go to all the retirees in America and say, guess what, we're cutting your Medicare and Social Security by 40%. And you want to go to all the defense contractors and say, guess what, we're cutting your income by 40%. And even if you did that, you would have an enormous recession and downturn, which would then trigger unemployment and welfare and food stamps. And I mean, it's kind of a Gordian knot. Now, don't get me wrong, they will do some things that are positive, and they will definitely be able to reduce the deficit somewhat at the margin. I mean, but again, one of the things I pointed out in my presentation was, so the big four in U.S. government spending are Social Security, Medicare, defense, and interest. That's 80%. So Social Security, and that's kind of the third rail. You touch that, you're going to get a lot of seniors pissed off. Medicare, same story. Defense, the military-industrial complex, now, but they can probably go after that a little bit because, they'll probably figure out a way to get the Ukraine war tamped down, and maybe they'll save some money there. Interest, they can't really do that unless the Fed chops rates to 1 or 2%, and they fund the whole thing at the short end. That would help on the interest side. So the other 20%, which is about $1.3 trillion, even if they whack that by 30%, that's only $270 billion. So, the government deficit last year was 1.8. This year it's running at 2.4, and the first 6 months annualized. So you whack 2.4 by 280, yeah, it helps. I mean, maybe they can whack it by 400 or 500. Okay, so 2.4 becomes 1.9. It's still bigger than last year. I mean, I guess the point I'm trying to make is they can slow it down. Reversing it and solving it is going to be really hard. And they're going to get, some eggs are going to get broken. Somebody's not going to be happy, either seniors or defense contractors, or they're going to have to run inflation. I mean, the way out of these debt cycles and debt crises is to either do a monetary reset or to run inflation really, really hot. And if you run inflation really hot, hotter than the growth of the debt, then ultimately your GDP gets bigger and it can support the debt. So, but you want to go tell this electorate that we're gonna turn inflation back on again? I mean, in 4 years you'll see a blue wave that'll make this red wave look small. So I mean, to my way of seeing it, the system is broken, the monetary system is broken, the political system is broken, and I think what's going to happen with elections for the next bunch of cycles is people are just going to be pissed off. They're going to vote the bums out, and it's going to be okay. So this time the red wins, and the next time the blue wins, and the next time the red, because there's no adult long-term thinking discussion about how we, in a sane and fair way, solve and address the problem. And the way you solve and address the problem is you do a one-time devaluation like Roosevelt did, you do a monetary reset, and you return to sound money. And if you did that, it would be inflationary. Don't get me wrong, people would get hurt, but at least, it's like drinking. I mean, it's like getting sober. you're a drunk and you keep taking more alcohol to stay drunk every time you have a hangover, you take alcohol. Well, eventually you got to go cold turkey. Hurts, really painful withdrawal symptoms. But then once you're sober, you're good. And so getting on a sound money standard to me is the equivalent of getting sober.
Okay. And to be clear on timeline, do you see that happening, or are we going to keep?
That's a great question, and I wrestle with that. First of all, nobody knows, right? Nobody knows. But I will make a couple of observations. It appears to be getting more and more critical. The lines are getting steeper, on the debt and on the interest. I mean, and they're compounding, and so that, I would say it's getting worse. And so I feel like this problem or crisis is going to come to a head in the next couple of years. They're pretty good at can kicking, so I'm totally willing to accept the possibility that, we're now in 2024, and I'm, thinking of this in fourth turning terms. I mean, maybe it stretches out to 2030. Maybe it's another 5 or 6 years. I just don't see it going much beyond that. I mean, I think and it's really, Charlotte, it's actually really just kind of the math. I mean, when you kind of, when you grow, when you compound, I don't think people understand the way compounding works. And so when you compound your debt and you compound your interest, it's really hard to get out of the trap. I mean, go back to the credit card, the family with the credit cards. I mean, generally the way that gets resolved is they file bankruptcy, and start over again. Maybe the U.S. is going to go bankrupt. I mean, it's extreme, but there has to be something very radical that takes place to restructure it and fix it. And I think, a very visionary leader with a ton of courage could maybe pull that off. But even that leader, the people would scream and yell. And so my sense is what will unfortunately happen is we will just keep running down this road, and we will have higher and higher and higher inflation, perhaps even something looking close to hyperinflation. And at that point in time, it will be so bad and so painful, and everyone will be so mad that they'll say, okay, I don't care how much pain it's going to take. We got to fix this goddamn thing. And I'm willing to get sober. Do you know what I mean? And so let's go back to sound money. Even if the first year of it is awful, what we're living in right now is pretty awful too. So you see what I'm saying? So that's kind of how I think it gets solved.
Yeah. I was asking you on timeline a little bit because, of course, we've got this 4 years of Trump coming up, and he's kind of known for making some off-the-cuff decisions.
Oh yeah.
Maybe that could be a thing that he does, but it sounds more like it needs to trickle down to everybody, and everybody just needs to together.
I think that's right. And I think it's going to be hard. I mean, it's look, I'm sure there are people, they're all jockeying for position in his future administration. And I'm sure there's some people in there saying, hey, look, we got to just break the glass right now and take the pain. But it's scary. It's very scary to take the pain. And the voters get to weigh in every 2 years. So, it'll be interesting to see.
Okay. So that's kind of our backdrop for one of the big things that's going on right now. I want to go over to gold as well. It's for
love gold.
So and we'll move on to Bitcoin later, of course, as well. But starting with gold. So gold has been on a tear this year. Of course, we saw the pullback just after the election, but we're coming back. And I'm curious to get your thoughts on gold's trajectory, given everything that's going on right now.
Yeah, well, it's a great question. So, as we all know, gold broke out. Gold was kind of trapped in a range. So gold did extremely well during the whole COVID thing. My fund did well, and gold did well, etc. And then when Powell slammed on the monetary brakes and stopped the growth of M2 and took rates up to 5.5%, gold stalled, right? And it kind of stalled around 2070. And it was range bound in there from 2020 to really March of this year. So that's 3 years. I mean, almost 4 years. So when it broke through 2070, that was very significant, and that told you that we're back into game on. And the reason I think it did that was I think it could smell what I described about the monetary situation, and so it knows, even though they haven't started printing money again, it knows that they're going to have to, and it smelled it. And that's why it went through 2070, squirted up to 2,700. I mean, this 27, 25, 26, this is just wiggles. Because we're going, and one of the things I find interesting, the reason the miners trade so poorly is everyone thinks this 27 is unusual, and we're going back to 2000. And just as a lot of people in the stock market think that we're going to go back to a deflationary world, and inflation's going to get calm, and the Fed, they're believing the Fed propaganda that, oh, we've landed the plane and the 2%'s in sight, and don't worry, it's all going to be good. I think it's all nonsense. I don't believe any of that. Okay, and so what I think is going to happen is it's going to be clear that they haven't landed the plane. It's going to be clear that inflation is still with us to a degree, maybe not to the 9% area, but in the 3 or 4% area. And that's, and then ultimately we're going to have a monetary problem driven by the math that I just described about the fiscal situation. And that's going to lead the bond market to sell off hard, or something will break, as it did with Silicon Valley Bank. And the Fed will have to come in with the monetary fire hoses and do the one thing they do really well, which is print money. And at that point in time, gold starts its next leg up. And, in this cycle, I can see it going to 3,000, 4,000, 5,000, higher. It's kind of unlimited. The price of gold is inversely correlated with how much money they print. If they stop printing money, gold doesn't go up. But when they print money, gold goes up. And they're going to have to print, but in the math we talked about earlier suggests they're going to have to print a lot of money. Now, they haven't done it yet, but it's coming, in my view.
Yeah. Okay. So, do you include silver in this?
Oh, absolutely. Yeah. So gold and silver track the same. Silver is kind of like the wild child of gold. As you know, it's a fraction of the market size of gold, and it doesn't have the big stock out there. It gets used, and which is why it's more volatile. When there's a shortage of it, the price goes much harder and faster. There's a big underlying stock of gold, and so there's not as likely to be a quote unquote shortage. But yes, typically, as we all know from studying these things in the past, when you have a bull market in precious metals, silver vastly outperforms gold. And so I'm very bulled up and excited about silver, and my fund is focused on a lot of the silver miners for just that reason. And I expect gold, in a year to let's say it's 3,500, kind of conservatively. I think silver is going to break through 50, probably be $75 or $100 within a year or two. So, which is as a multiple, when it's at 30 now, that's a much higher multiple than the growth in gold. So yeah, they're related. And but silver, just as we'll get to Bitcoin, but silver's more volatile than gold, right? There's a price to pay. Okay, so silver could outperform gold. Great. Yeah, that's the good news. The bad news is it goes down faster than gold too. So because it's not the same thing. So.
Right, and let's go back to you're mentioning the gold stocks. Why are they not all in?
Yeah. So, well, I think there are two things. And these were made on the panel yesterday. And the guy next to me made a very good point. And I agree with him, which is one, the Magnificent Seven and the U.S. stock market at record highs have kind of been sucking the oxygen out of the room. So the average investor, if you own Apple, you own all those other, stocks, you own the NASDAQ and triple Qs, you've done pretty well for, the last 10, 15 years. And, you're going to stick with it. It's kind of like, this is working. Why should I leave? And, NVIDIA, good God, there have been some killer stocks, right? So that's one. So people don't think they're doing anything wrong, even though all those stocks are at record valuations, and I think are at very great risk of eventually entering a bear market. I'd say the second thing is that the gold stocks, it's a spread business where you're making the difference between the price of gold and your cost of mining. Cost of mining is your what they call your ASIC, your average sustaining cost to pull an ounce out of the ground, and that's going up with inflation pretty consistently every year. ASICs used to be, 2 years ago they were $1,000 an ounce. Now they're $1,400 an ounce, and in 5 years they'll probably be $1,800 or $1,900 an ounce. So you need higher gold prices to keep your margins the same. And I think what's going on is as I said earlier, I think a lot of people kind of believe that this 25, 6, 700 price, it's an anomaly. I'm seeing a lot of models out of Toronto and other places. We're going back to 2,100. You get on Bloomberg and you Google analyst consensus estimate for 5-year out gold prices. It's like 20. It's like 2,000, or maybe 2,100. Well, guys, 5 years out, I think gold's going to be 4,000. So, and I think as a result of that, people are saying to themselves, well, these stocks, if gold goes back down and we know there's inflation, so their mining costs are going to go up, their margins are going to be shrinking. Why should I own them? And so what needs to happen is we need to have that psychological shift where people go, oh, you know what? Gold's not going back down. In fact, gold's going up. In fact, gold's going up a lot. And these margins are, and yeah, there'll be 10% inflation in the ASICs, but guess what? The price of gold is going to go up more than 10% a year. So the margins are going to be growing. And then suddenly everybody will be discounting and building models on $3,500 gold. And I can assure you, I mean, my companies that I've invested in, they're doing really well at, they were doing well at 2070. They're doing great at $2,500 or $2,600 gold. And I mean, they'll be just coining and minting money at $3,500 gold. And that's where I think we're going. But I don't think the market believes that. And that's why I think the stocks, but what will happen if this is the way it's worked in past markets, and I've been in this few cycles and watched it historically, is there'll come a moment of recognition and then they'll make up for lost time. So I fully expect, my fund this year is up about 40%. I mean, if that moment of recognition occurs next year, and looking back historically, I mean, my fund go up 100% in a year. I mean, because they're so undervalued right now. But I know that for people watching this and listening to this, it's really annoying and it's really painful, and you've got to be really patient. And I'm as angry as anybody about it that it's taking this long. But it's like, I'm not selling. I mean, I want to see the next card. And I'm pretty sure, I mean, based on historical recognition of patterns and studying everything else, I'm pretty sure the next couple of years are going to be good for us. I'm pretty sure. I can't be sure, can't be positive, but.
So he can be mad, just don't leave yet.
Just be mad, but yeah, don't sell. Don't sell your stocks. I mean, I think we're right on the cusp of getting paid in a big way. Yeah.
Okay. And so on this panel yesterday, everybody was talking about, different their picks for companies.
Yeah.
I'm wondering, can you talk a little bit about how the criteria that you use to select?
Sure. Yeah, that's great. So, let's talk about the buckets. There are 3 buckets of gold company. There are drill stories, who are, they're poking holes in the ground trying to find a big deposit. And that's the riskiest segment, okay? But it's also got the potential for the largest reward, because some of these things have, $10 million market caps, and they poke a few holes and they find 1 million ounces of gold. Well, 1 million ounces of gold is worth $2.5 billion. And so, you've got drill stories. When you hit on a drill story, it'll go up 10x or 20x or 40x. So, but not all of them hit, of course. So that's the riskiest category to be in. The safest category to be in is the one I specialize in, which are the producer category. These are companies who have a known deposit, 43101 certified, and they also have production, and so they've got positive cash flow. And the thing that makes them safer is they're not at the whims of the market. They don't have to raise money. I mean, a drill story has to continually raise money and dilute the investors to stay alive. They don't raise money, they die. Okay. Producers, at least they have a positive cash flow. They may not trade well, but they have positive cash flow. They're not going to go bankrupt unless the mine blows up. The sweet spot of the producer category is what I call the growing producer. I mean, obviously, you can buy the big safe producers, like, the best one in that category probably is Agnico, and the second best is maybe Kinross. But those are really big companies, and it's hard to grow. When you're producing millions of ounces a year, your growth isn't going to be very large. What I like to do is find the more middle category producer. They've got a mine or two that are working, and they're going to add another couple more mines. So that you kind of got a twofer. You got a producer that's producing cash, but they're going to use that cash to produce more, and therefore it's going to grow, so profits are going to go up. So emerging producers is kind of the sweet spot of what I try and do, and I think they're the best area to invest in. The third area is an interesting area. It's a hybrid of the two. It's not a drill story, although, and all these have somewhat of a drill story piece to them, because a producer can be drilling a new property and they hit a deposit. Oh, bingo, it's a really good thing. But I'm just talking about kind of generalities. On the developer side, so the developer is the third category. What they do, they have a known deposit. They know they've got a bunch of gold in the ground, and they're trying to figure out, okay, if we raise this amount of money and took this amount of time and got these set of permits, we could have gold coming out of the ground and we could have cash flow in 3 years. And they usually sell at some fraction of what they will be worth when all those things occur. And then, of course, one has to decide, how likely are those things to occur? How much is it going to cost? And, of course, there'll be cost overruns. And, are they going to produce at the level they thought they were going to produce at? Because the process might not work the way they thought it will. And, it's Murphy's Law. There are like 10 things that can go wrong. However, if you have a really good management team and a really good deposit and you buy it cheap enough, you can make a lot of money on those too. But you want to buy them at the right point in the cycle. I'm sure your listeners generally know what the Lassonde curve is. You don't want to buy them when they're a long way away from production, because there's just a lot of things that can go wrong, take a lot of time. It's dead money. But if you can get them, if for some reason they're getting pretty close to production and they're still reasonably priced risk-reward wise, and the management team is good so that the projections are credible, they can do very well in those. So I have some of those too. But the one thing I would say to people looking at this space is either have a professional help you do it, or buy an index just to be diversified and safe, or really try and do the work to understand what companies you're involved with and invest with good people, because it is an industry that has a very wide range of management competence, and you really want to try and be with the people who know what they're doing, because it's another thing about it as an industry. It's an industry where you lose all your money. I mean, I was investing before this. I was investing in a lot of other general companies, and investing in the average company doesn't go bankrupt. Lots of miners go bankrupt, right? And so if you blow the call, if you get the bad management team, you can go bankrupt, which is no fun. Yeah.
Not fun at all. And I like how a wide range of manager. Yeah. Okay.
You know what I'm talking about, right? You've been in this industry, and anyone who knows the industry understands what I'm saying.
Okay, so really good to go over the gold stocks, and let's head over to Bitcoin now, which I'll need your help. It's not my area of expertise, but let's see how we do. So we had gold, as we talked about, went down after the election, and Bitcoin, meanwhile, a total opposite direction. And we were talking before we turned the cameras on. Is it at 100,000 yet? Not quite.
It's close, yeah.
So maybe you can help me understand what's going on there. Is this optimism about Trump being pro-crypto? What is?
Yeah, it's a great question, and I'll try and pull it apart. There are different pieces to it. So first, a couple of things I think are interesting, and your readers or listeners might enjoy understanding. Bitcoin sat flat most of this year. Bitcoin was stuck. There was a big joke about it on Twitter, the meme, the 58,000 club. It just kept hitting 58,000. Wouldn't go anywhere. Gold broke out, and I own both, and I have friends in both camps, and I think the camps should be friends, not enemies. But I found all the Bitcoiners saying, hey, what the hell's going on? Gold's going up, and our shit's not. And I was like, this is the way it happened every last couple of cycles. Gold is bigger, more widely distributed, more people understand it. It smells it first. Gold moved first. I said, you should be happy that gold's moving, because it means Bitcoin's about to move. And it was about the same amount of a lag time. It was like 3 or 4 months. Gold broke out in March, and no, it was more than 3 or 4 months. It was about 6 months. And then Bitcoin really started moving this fall, right? And now it's moved with great authority. With respect to the Trump thing, yes. I mean, I think what happened is, look, gold has had one hell of a year. There aren't a lot of years where gold's up 30% from 2070 to 2700. That's a hell of a good move for gold, and it was ready for a rest. Bitcoin, on the other hand, had just started to move, and yes, I think the final thing that pushed the Bitcoin move was that the Harris administration, the Biden administration with was it Pocahontas? The Senator Warren hates Bitcoin. They hated Bitcoin. They were giving all the Bitcoin companies tons and tons of trouble. There were a lot of worries about what might happen to it, and if Harris won. And obviously Trump has signaled, and Kennedy and others have signaled that they're extremely pro-Bitcoin. And you've got now Senator Loomis has introduced a bill for a Bitcoin strategic reserve, which would be a huge thing if the U.S. government started buying Bitcoin and putting it on its balance sheet, the way we have gold as a store of value. So I think that the political earthquake that kind of occurred when Trump won was extremely positive for Bitcoin, and that really added rocket fuel to it. So yeah, I think that's the biggest part of the explanation.
Right, and I think, again, we have to ask, so what do you think he may actually accomplish out of these many promises?
Well, yeah, I think he's well-intentioned, and I'm very encouraged that his team this time around, I think, is much better than his prior team. I mean, I was a Kennedy supporter. I believe RFK was a very good candidate. I'm a Tulsi Gabbard fan. He did not bring the neocons back. I mean, he left Pompeo out. He left Nikki Haley out. And I do think he's kind of anti-war, and there's a chance that he'll figure out a solution to the Ukraine problem. Honestly, I don't know, Charlotte, how much he can accomplish. I mean, I think, I think his idea of trying to enforce fair trade by using tariffs as a threat is a good idea. I think in general, tariffs are a bad idea. I mean, they're going to slow down trade, be inflationary, cause problems. But I think if you want to hold them up as a threat and say, hey, look, you guys, you don't play fair with us, we're going to put a tariff on you. It's a good idea. Make them play fair with us. I think that the Doge committee, that Vivek and Elon, they will cut some expenses. They will get us moving in the right direction, and they'll slow down the just absolutely insane spending, and that's a net positive for the country. But I don't think it will be enough to prevent what I call kind of the revolt of the bond market, which I then think is going to lead to what I said earlier, kind of the big print. And I think when the big print comes, our stuff's going to go nuts. I mean, I'm like I said, I think we were talking off camera before, and I fully expect Bitcoin's going to go to 200,000. I fully expect gold's going to go to 5,000 in the next couple of years. So, and I mean, I can assure you, if running a gold stock mining fund, gold goes to 5,000. Oh my goodness! I mean, this stuff is. I mean, all the suffering gold stockholders out there, like you, me, and probably a lot of your listeners who've been wondering what the hell is going on. This stuff stinks. We're going to be very pleasantly surprised. So that's what I see coming. But it hasn't happened yet, and I could be dead ass wrong. And it's hard to be patient. I mean, I get it. It's really hard. I mean, I'm having a hard time being patient. So, totally understanding all the frustration, but I don't know what else to do, because it's not like I want to go buy bonds, and it's not like, I mean, it'd be another thing if the stock market were fairly priced and there were some really good opportunities over there. I'd say, okay, fine, let's go buy stocks. But the stock market it's a record. If you look at the numbers on the stock market, I mean, we are more expensive than we were in 1929. It's really crazy overvalued. So.
Okay. So we've got kind of the Bitcoin price outlook came into there, so we covered that one. What I do want to, as we get to the end, kind of ask you is, so we're here at this conference with traditionally this is focused on gold. I feel like we are getting a little bit...
It's shifting, isn't it? Yeah, I feel that, yeah.
So for people here or in the audience, you might be thinking, all right, I'm ready for Bitcoin, let's do this. What is a good level to get in at the moment? How should they approach it?
Yeah, that's a great question. So a couple things that I think you'll find interesting. When I did my presentation on Wednesday night, I asked how many people here own Bitcoin. It was more than half, well over half, maybe 60%. So, and these are gold people here for sure. But to answer your question, how do you get into it? I mean, I always say to my clients, the only wrong allocation to Bitcoin is zero. And gold and Bitcoin are different. They're both sound money assets. I call gold analog sound money. I call Bitcoin digital sound money. Bitcoin is growing faster than gold because it's on an adoption curve, and it's got a lot more asymmetry than gold, but there's a price to that, and the price is volatility. You have to understand that we've had 4 or 5 cycles where the price of Bitcoin has gone down over 50%. So, and so the time where I've seen people get hurt is they buy Bitcoin, it goes down 50%, they panic and they sell it. Because if you wait 4 years, it always comes back and goes on to a new high. But you've got to understand what you're buying. But back to how one goes about buying it, I think you make a decision that you want to buy it. You can buy it through an ETF. You could do self-custody. There are reasons to do that, but it's more complicated. And I think maybe you start with probably the best book on the subject, which is a book called The Bitcoin Standard by Saifedean Ammous, Ammous, widely available on Amazon. It's probably the best-selling Bitcoin book by far. And it will really kind of walk you through and explain the investment case for Bitcoin and then how you do it. And then beyond that, there are some other books that kind of teach you, some of the subtleties about how the network operates and self-custody. And, it's a big rabbit hole and you kind of got to go through it. But if you the beautiful thing, one of the big positives that happened this year, and I think actually did drive the Bitcoin price a lot, and I was shocked it happened, to be honest with you. I thought they wouldn't do it. When they approved the Bitcoin ETFs, that was a big deal. I mean, a lot of people who were my friends said, well, I'm not going to invest in that because the government's going to outlaw it. There's no way they're going to let that happen. It's money they can't control. They don't want you to do that. Well, okay. But then the SEC approves an ETF that has it. And I was like, oh, well, that's a little different, isn't it? So, so now if you have a stock brokerage account, you can say, buy me FBTC or buy me IBIT, and you effectively own Bitcoin. Now, you don't entirely own it. You own it as a proxy through a brokerage. And if that brokerage fails, or if the government decides to seize all the Bitcoin, you've got a problem. And that's another layer that's down the rabbit hole that leads to self-custody, which means you've got to get your own cold wallet and you've got to learn how to self-custody. You got to learn how to store it. You don't learn this overnight, but it's imminently learnable. And any Bitcoiner that if you have a friend who's a Bitcoiner, they'd be happy to teach it to you. There are tons of videos and books that teach it. There's a guy on Twitter called BTC Sessions. He has an enormous number of videos, and you just go watch those, and pretty soon you'll be a Bitcoin expert. You'll feel very comfortable having your own coins and self-custodying, and you'll have what I consider to be the most asymmetric bet out there. I mean, again, I would really encourage people to go to my Twitter feed, look back a day or two, and click on my presentation, because there's some charts in there that show the performance, the relative performance of Bitcoin, gold, and the S&P. It's just crushing everything. And so, if, as I say to people, okay, maybe you don't believe in it, or, and I'm never suggesting anyone should put all their money in Bitcoin, but to have zero of something that might really go, I think this will go up 10x, and then I think it'll go up 10x again. I'm talking over a decade, okay? But if that's really what it's likely to do you want to own none of it? Why not have 1% of it or 10% of it? If 1% and you're wrong, so you lose 1%. If you're right, you might make 10x, you might make 100x. So it's that kind of a thing. It's a very asymmetric bet. So that's why I'm so positive about it. Yeah.
Okay. A lot of good information. I'll try to dig up your presentation slides. I can link it in.
You can link it in. It's right on my Twitter feed. Yeah.
I'll take a look for that. Okay. I think we've covered.
Did we get what you want?
Out here.
Okay.
I think so. Did you have any final thoughts you leave people with? Did we get it?
No, I think that's it. I think you basically got the message, and you're a very good interviewer. So I just keep saying the same thing over and over again. What I really, the thing I would just say to people, I'll make one broad statement. If we're in a sovereign debt crisis, and I think we are, and if we're going to have a lot of inflation, I think we do, and if we're going to go to have a monetary reset, there are going to be real winners and losers, and you're not going to get a do-over. You're not going to get a do-over. It's not going to be like, oh gosh, I missed it. Maybe I'll, it's like we could wake up one day and the government could say, we're going to a gold standard, we're taking the price of gold up to $20,000. Well, you either own gold and gold mining stocks or you don't. They're going to go up enormously. The same thing with Bitcoin. The U.S. could say we're going to do a strategic Bitcoin reserve and the Bitcoin price could triple. Well, if you don't have any, you don't benefit from that. So there will be, because of the risk of monetary debasement and the fact that there will be no do-over, I would just strongly encourage all of your listeners to have some allocation of their wealth into things that the government can't print. The government can't print gold, government can't print silver, government can't print Bitcoin, and the government can print dollars, and they're going to print a shitload of dollars, in my opinion. So that's what I would leave you with.
This is Laurel, and thank you very much.
Thank you so much. Yeah, I really enjoyed it.
Okay, and once again, I'm Charlotte McLeod with investingease.com, and this is Lord Lepard.